Hi, welcome to the Market Week in Review for the week ending 16th of January 2026. My name is Alex Cousley. I'm a portfolio manager based out of Sydney, and it was a pretty busy week this week. We had corporate earnings out of the United States, some economic data, we had credit numbers out of China, and some political developments in Japan. So if we get into it, starting with the US, earnings season for Q4 has kicked off with the big banks reporting, and generally it was a sign of stronger than expected earnings. So most of the banks beat on earnings, quite a few beat on revenue expectations. It wasn't all positive. There were some indications of more capex coming through than the market had anticipated, and the market reacted to that a little bit. But broadly, if you think about what the US economy looks like, banks are saying that the environment is still quite healthy. We also had Delta, the airline report, and they kind of reaffirmed the K-shaped economy idea, where they've had a very strong start of 2026 in terms of bookings, and it's really been driven by business class and the premium class. So the higher income consumers are still driving quite a bit of the spending. On the economic data front, we got the inflation numbers where we sort of saw a bit of downside surprise to core inflation. Don't think it's a huge game changer to the Fed. We still think the Fed are likely to stay on hold, maybe one rate cut through the year, given our backdrop that the economy we think is beginning to reaccelerate on the support from fiscal stimulus, that consumer spending that we've talked about, and also the capital expenditure profile continuing for artificial intelligence. On the labor market, we have the jobless claims, the weekly jobless claims, and that's continued a pretty healthy down move. So less people filing for unemployment insurance each week, which is quite encouraging, and kind of continues this low higher, low fire thematic that we've seen through 2025, which we do think will break up to the upside in terms of more hirings on that reacceleration. If we move across to China, China had two pieces of data out. As a backdrop, we're still in this low of a fairly soft growth environment for China, where export growth is still the one of the bigger drivers, and that continued with the trade data. So exports were stronger than expected. And then on the credit side, we get a better insight into how households and businesses are feeling about the economy, where we've been in an environment of pretty soft credit demand, and that continued. So given the housing market is still quite soft and the consumer is cautious, we aren't seeing much demand from consumers. Corporates are being quite cautious, and local government bond issuance has not really picked up yet. That will pick up through the year, given the issuance quotas that get given. But yeah, we haven't seen much of that coming through to date. Finally, in Japan, where we had some political developments come through. So Takaichi, the Prime Minister of Japan, looks likely to call a snap election, likely to be done around February 8th is the kind of best guess right now. And we saw quite a bit of movement in markets on the back of that. So starting with equity markets, the Topics, which is the main Japanese indice, was up 5% as of recording this on Thursday close. And that's really been on the view that Takaichi's two kind of campaigns or campaign fronts. One is a stronger stance on China, but the second is more fiscal stimulus and a more aggressive profile of fiscal stimulus. And so the Japanese market responding quite nicely to that. The other area that responded was the dollar yen, or the yen in general. So dollar yen went through 158.5, which is, haven't been there for a little bit. And we're getting close to the 160 to 161, which is the standard or the typical level that people talk about in terms of Bank of Japan Ministry of Finance intervention. It's very hard to forecast if that will happen, how big it will occur. One of the interesting things, though, when looking through some of the positioning setups, so the last couple of times we've been sitting at 158, heading towards 160, is that the market has been very short yen, and we can see that through CFTC data on futures. This time around, we really don't see that. We actually see pretty clean positioning. So not a large long position, not a long short position. And that is a very interesting backdrop. So if you think about the yen from a cycle value and sentiment process, we think this valuations are very cheap. The yen is one of the cheapest currencies out there. The cycle is a little bit supportive if the Bank of Japan keep raising rates gradually and the Fed stay on hold, or actually maybe do that one rate cut. But the sentiment is not really that attractive right now. And so we don't think it's at a level that is an unsustainable extreme tactical opportunity. We're closely watching those positioning numbers over the coming weeks as we head into and out of that snap election. With that, I might leave it there. Thank Thank you for listening. I look forward to speaking to you next time.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.